Good morning, everybody. Happy Monday. We're going to get started in just a second. Okie dokie. We have a fresh trading week ahead. It's a holiday shortened trading week, by the way. Friday is Good Friday, so the U.S. markets, global markets for the most part, are going to be closed. I would expect trading volume to severely decline by Thursday. You can have plenty of markets that are going to get really slow by Thursday. Obviously, depending on news. I actually would expect news flow to slow down a bit this week because of that as well, and then maybe pick up again the following week. So that's kind of what I'm expecting for the next trading week, which actually should be equity positive. Again, all else being equal without any major news flow. So let's get started. Good morning, everybody. Serge Berger here from thesteadytrader.com. Hope everyone had a great weekend. If you haven't had a chance to join us in the State of the Market yesterday, I would urge you to do so. We're doing one today. I believe it's at noon Eastern. I'm actually going to check quickly. So make sure you join that. If you haven't joined, we had absolute record attendance yesterday on that. People want to know what's going on with the market. So if you haven't joined us, I'm going to do another one today at noon because we had so many people that I emailed us that they didn't. We had so many people joining, but also then so many people telling us, hey, they couldn't join because it was a Sunday and Masters or whatever, all sorts of reasons. Understandable. So we're going to do another one today at noon. Looking forward to having you guys there. All right, what are we going to talk about today? On the note, and obviously it's Monday morning, so it's time to get after it. On the notepad this morning, we have a few things we need to talk about. First of all, we do need to talk about the dollar because the dollar has reached a point where we think we could see a bounce. This is more near term, obviously. Then we need to talk about the long bond because, yes, that matters to your stocks. Then we will look at the S&P 500. We'll look at Apple. And then we'll look at gold miners, which are really giving us some positive vibes here. So let's get started, see if we can get through this in the next 10 minutes. Before we even look at equities, let's look at the dollar first, and then we need to look at bonds. Because guess what? That's what wags the tail. Tail being equities. So when you look at the dollar, a big sell-off from the dollar. And as you'll find out more when you come to the State of the Market later on today, or you heard yesterday in the State of the Market, what's going on in the dollar is very closely related to what's going on in gold. And ultimately, you could even make that relationship to the equity market, where you are seeing foreign holders of treasuries, and our research indicates this has largely been Chinese, are selling some treasuries, and that's causing a dislocation because they're buying with those dollars that they receive from selling treasuries, they're buying gold. By the way, it's nothing new. It's been taking place for more than a year. We've talked about it. We had a big podcast about it last April or May or June. I can't remember. At the time, people thought we were crazy but then again, it's just what we're seeing, right? So clearly, the observations that we see on the tape are better than narratives that people read on Twitter from someone who really is just making up stuff in order to get some clicks. But now you might be getting to a point, and this is kind of where I'm at for this week, right? So this is now a very near-term thing. And again, as I said before, none of this here really matters if the headlines get a lot worse this week. But I think this week, given we have a holiday shortened Easter week, I think the likelihood is pretty good that the news flow becomes less aggressive and maybe a little bit more positive. we are going to have much bigger problems down the road. Again, that's why you want to come to the state of the market and watch that. But let's focus on this week for now. Here it's a Monday morning. The dollar is oversold in my view in the near term. There are bigger problems down the road. I would imagine the dollar to go lower, but again, for the near term here, I think we're oversold, and that has implications, believe it or not, to the bond market and to the equity market, right? So we've had essentially a positive correlation between the dollar market, so dollar down has meant equities down, because what's happening is people are actually leaving the U.S. equity space. Obviously not entirely, but there's net outflows. That's what we've been seeing. And yes, the conspiracy theorist here will bring up that it's all retaliatory. I don't think the equity space is retaliatory. It's just people seeing other opportunities and they're just seeing a bit more defensive. So that makes sense that they're taking down some of the equity exposure. By the way, retail has not sold any equity exposure yet, which is why I think the retail is in big trouble, which is why we're doing all this live information for you, so you don't get caught with that. But the dollar index oversold, so we think we could bounce. Now, if the inverse of that or actually the same the inverse of that is yields, particularly in the long end. So if you look at the 30-year bond yield, it's gone straight up. So this is basically bond prices going down, bond yield going up. And so as people have left the dollar, part of what they've been doing is they have sold treasuries, right? And so particularly in the long end, on the short end, it's not as severe, which is why we've seen what's called a yield curve steepening. And again, this actually does matter. If you don't care about this stuff, if you haven't cared because all you've done is bought Apple on 10% dips for 10 years, like that era is now over, and you got to become much more, aware of these big things. But the 10-year yield, or the 30-year yield, excuse me, I hate to jump around too much, is, Jesus, let me type this in properly. I promise. I worked the entire weekend, and I mean like 10 hours each weekend at least to get the research straight. So we think bond yields are overbought. Dollar oversold, bond yields overbought, meaning bond prices oversold. So one trade that would be interesting here, and this is a bit of an oversimplification, but just to give you an idea, for example, TLT as an ETF. I think we could see a bounce. So, and again, I think from a headline perspective this week, it would be feasible to expect less crazy headlines. That could be totally wrong, right? And if that's wrong, then all bets are off on this call. But I would expect that to be happening. The VIX, by the way, still very elevated, in the low 30s. But I would expect the VIX to come down. In fact, the VIX, if I show you the VIX on our here. So first of all, the S&P 500 on the Vertical X Pro, which is our indicator that tells us when something is extremely overbought or oversold. We received, I think I mentioned this last week, 20 or 30 pages on our Vertical X Pro indicator of extremely oversold stocks. And that included the S&P 500, the SPY ETF, which, I don't remember last time this happened. It happened during COVID, actually. And so typically speaking, the S&P will bounce. It actually did bounce 8%. I would expect that to be able to continue for a little bit. Again, bearing any really, really terrible news out of, trade war with China and so on and so forth. But I think that too lines up. The VIX, by the way, is the inverse of that. The VIX, again, got very overbought. You can see it typically doesn't get that overbought, rarely gets that overbought, particularly on a weekly basis. And when it does, the VIX does come down. I don't think the VIX has it in it to get down in the low 20s. I've been surprised by that before. So obviously grain of salt here, but still it got overbought. So that's the inverse of saying equities are a bit oversold. Now, when we look at the S&P 500 specifically, which is now kind of where we're at as far as the risk analysis is, I would expect that we could have some more upside here, as I just said, in the broader market. I'm actually quite concerned about, or that's the wrong term. I'm more interested in taking risk here, taking positions on the macro side as opposed to individual stocks, although we are going to look at Apple and gold miners here in a minute. But I would not be surprised if we see the S&P 500, push higher. Maybe we see the SPY towards 560, 570. Like, I think that's entirely possible. If you want to be technical about it and draw lines, then you would come to the conclusion that would come to about a 61.8% retracement, which is also, again, kind of what one would expect. It would maybe a retest of the 200-day moving average, which is the red line, the sort of kissing the underbelly of that. I think that's entirely possible. Remember, some of the biggest rallies happen in the context of bear markets, and the S&P 500 so far has actually dropped 20%. I will share you something really quickly before we look at Apple and gold miners. This is just one of the big takeaways from the state of the market. Again, we're doing it again today live at noon, so make sure you join us there if you haven't done so yet. The S&P 500's mean reversion so far from the sell-off has basically gotten it to the midpoint of the rally since 2009, so since the great financial crisis. You can see the lower end of that, of course, is the COVID lows. I do think we get down there, and if I now zoom into this part here closer, I get to this chart. So this is the same thing I just showed you, but zoomed in. So again, you can see the 20% drawdown. So if we were to see us getting to the lower end of that range, which could be somewhere in the low 4,000s, I would expect another 10% or so to be possible to make it a full 30%. Again, that's not today's action. I don't think that's today's this week's time frame either. Again, bearing any really crappy news, but I do expect that to happen over the course of the next few months, maybe a few quarters. Again, we'll have to see how that plays out. But I think that's directionally how we kind of see things playing out. Let me just take a quick look and see if there's any questions. If anyone is sort of aware yet that it's a Monday morning, so it's always a bit slower, and I fully understand that. Let's have a look at Apple, and then we'll look at gold miners and gold. So the price of Apple has obviously suffered, and that's because of the whole tariff thing, where the selling accelerated. We are this morning seeing the stock up 6 or 7%. I personally would look to be more of a seller of that stock ultimately than a buyer. And again, it's because I don't think the tariff thing is going to be something that will leave people's minds, even if they were to say, oh, just kidding, all tariffs are off, right? Which is kind of a little bit what's happening to Apple this morning. So the stock is up, trading around 210 pre-market. So let me show you what that looks like. So 210 pre-market is about, in fact, it's not about, it's exactly right there. Let me make that a bit more clear. So 210 pre-market is where Apple is trading right now. Now, the way I like to look at this, markets tend to gap, particularly in markets like these. There is an unfilled gap that extends all the way up to about 222, maybe even 230 if we want to retest the 200-day moving average, which I think is possible. So I personally am not really giddy to do much in Apple this morning, but if we do get a rally up into the 220s, let's say, I think that would be, to me, a pretty interesting spot to putting on some bearish positions. That could be done through, I would probably be doing it at that point with options, with bear call spreads. One could do a directional trade, just be short Apple or buy some puts or an inverse ETF. I don't even know if that exists on Apple. It probably does because we live in crazy times. But that would be kind of the thing that I would be looking for as far as Apple is concerned here. So I guess that would be my take on Apple. And then, gold miners, and this is important. I mean, there are so many things here. Now, I'll quickly share this with you again. This is from the State of the Market deck that we will go through again today at noon live, and I say noon Eastern time. Let me just show you a couple of charts on what's going on with gold, and then we'll end on this, and then I'll see you guys over in Trade Ops in a few minutes because we need to start getting ready for the trading day. Well, I've been getting ready, but to actually start putting on some trades. I'm along a bit of the S&P 500 right now, or actually NASDAQ 100, just so you know. So gold versus the S&P 500. What can we make of a chart like this? Gold versus the S&P 500 is showing us that the S&P 500 probably has more downside versus gold. Now, again, remember, this is a long-term chart. So this week, I could easily envision a situation where gold starts to consolidate. It's had a big move. But if you look at this through a multi-month lens, gold to me has more upside, certainly in relative terms versus stocks, but also in absolute terms. In fact, if you look at gold versus the Dow Jones Industrial Average, or the Dow Jones versus gold, you can see that this is the Dow versus gold. It's about to break down. Now, again, I think gold could consolidate in the near term, which would mean that this chart would bounce. But ultimately, this is actually very bearish, very bullish for gold, and probably quite bearish for stocks in the long term. And then you have gold miners, which, like GDX, for example, last week had a breakout move, a notable breakout move. And I think that is something that we want to respect. I would not be surprised if the machines start to take over. Gold has a bit of a consolidation period here, and gold miners and silver miners have a day in the sun. Again, that's a bit of a risky call, I will admit, because typically speaking, you don't see gold go down and gold miners up. But if the machines want to take over, it would not be unreasonable to expect that gold miners might start to outperform gold going forward, which typically should happen at some point when people start chasing that gold trade. So from a alpha near-term perspective, I would be quite interested in getting long gold. I am long gold miners, just to be very clear. But from a trading perspective, I think that's interesting. Again, if the equity market bounces sharply this week, then I don't know if gold has to participate in that, or gold miners for that matter. But this is a chart that I would want to respect. This is a meaningful multi-year weekly breakout from gold miners last week, so I would not want to disrespect that. Same thing for silver miners last week. Again, a 5-year breakout, or an attempted breakout. It looks like it wants a breakout. We had a big outside reversal day in silver mining stocks last week, so that's something that we're watching there as well. So that's about what I have for this morning, folks. I'm seeing you guys over in Trade Ops here in just a couple of minutes. I've got a bunch of trades that we're going to be looking at here, and hopefully executing in real time. And then I'll see you in the State of the Market at noon Eastern this morning as well. You don't want to miss that. See you guys there. Thanks for being here. Again, very important. Please subscribe to the channel on YouTube, because that allows you to be alerted in real time when we go live, and it allows us to be able to continue to do this morning show. And also, please give us a thumbs up. As always, that really helps us to be able to continue this. And it costs us money and obviously time and effort to run this show for free here on YouTube. So just please do us that favor. Subscribe. Spread the word to everyone. If you find this is helpful, give us a thumbs up, and we'll see you over in Trade Ops in just a few minutes, and back here at 9 o'clock Eastern, New York time, tomorrow morning. Thanks for being here. Have a great day.